Today, I'll be breaking down Amazon's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Amazon's growth narrative is truly extraordinary. Within the last 10 years, Amazon has experienced an impressive revenue increase of 644.1%, maintaining an average annual growth rate of 22.2%. Looking at net income growth, Amazon has consistently achieved an impressive annual growth rate of 53.6%, leading to a staggering total increase of 7,228.1%. Impressive, indeed. Earnings per share have also seen a phenomenal rise, with a total growth of 6,300%, which breaks down to an annual average growth rate of 51.6%. However, there is a contrasting tale when we examine free cash flows. Up until 2020, Amazon's free cash flows soared, reaching $21.8 billion and closely following net income's trajectory. But since that peak, there has been a significant divergence. While net income stands at $20 billion, free cash flows have dipped into the negative at $1.9 billion, indicating a point of concern. The question at hand is, what led to the downturn in Amazon's free cash flows? Now, let's shift gears to profitability dimension. Over the last 10 years, Amazon has averaged a gross margin of 11.5%, with the figure now at a more robust 15.2%. The contribution from AWS have undoubtedly played a significant role in this enhancement. Currently, Amazon's operating margin stands at 4.8%, which is a modest improvement over the 10-year average of 3.4%. When it comes to free cash flow margin, Amazon has seen an average of 1.9% during the past decade. However, in line with the previously discussed negative free cash flows, the current margin has unfortunately dipped to -0.3%. Lastly, looking at the return on invested capital, Amazon has averaged 9.8% over the past decade. Presently, this has slightly declined to 8%. Moving on to the solvency dimension. Amazon's quick ratio has seen a 10-year average of 0.91, but the current value has dipped to 0.7. On a brighter note, the debt-to-equity ratio, which has held an average of 0.94 over the last decade, has seen a positive shift, decreasing to 0.75. The net debt-to-EBITDA ratio currently stands at 0.98, marking a significant change from the 10-year average of -0.1. Historically, Amazon has maintained a position of having more cash than debt. Although this is no longer the case, a current ratio of 0.98 is still considered to be a healthy indicator. Lastly, the debt to free cash flow. With Amazon's free cash flows being negative, the company's current yearly cash flows are naturally insufficient to cover its debt. Nevertheless, this should not be cause for alarm, as I have a strong conviction in Amazon's capacity to generate robust cash flows annually. Turning to the critical fourth dimension, valuation. The enterprise value to sales ratio, with a 10-year average of 3.57x, currently sits at a lower 3.11x, suggesting a possible undervaluation of Amazon. Similarly, the enterprise value to EBITDA multiple, which has a 10-year average of almost 38x, has decreased to 23x, again hinting a potential undervaluation. Since Amazon's free cash flows are currently negative, it's not feasible to compute the price to free cash flow multiple. Lastly, the price-to-earnings ratio presently is around 82x, compared to a 10-year average of 225x. This substantial decrease further suggests that Amazon stock may currently be undervalued, even though the current multiple still stands high. Addressing the fifth and final dimension, shareholder returns. Given that Amazon does not pay any dividends, the metrics dividend growth, dividend yield, and payout ratio are not applicable, hence they are assigned a score of 1 by default. The critical metric of shares outstanding reveals that there has been a dilution on Amazon's shareholders throughout this decade. This is evidenced by an 11.8% rise in the total number of shares in circulation. Not understandable for a company with the size of Amazon. To summarize, here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 2.8. Now let's move on to Amazon's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Amazon's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Amazon's stock fair value at $183, over 15% higher than the current stock price, which indicates that the stock is undervalued. In a more optimistic bull case, Amazon's stock fair value is estimated at $326, indicating a potential for more than 100% upside from the current stock price. Conversely, the bear case presents a fair value estimation for Amazon stock at $82, which is 48.5% below than the current stock price, implying that the stock could be overvalued. Wrapping things up, Amazon scores a positive 5D rating of 2.8, and with a price target of $192, it looks like the stock might be undervalued by 20%. Putting all together, my final verdict is, next round, Analysis 2.0. Amazon may not be the standout business we've previously encountered on this channel, yet it's far from a poor performer. It boasts a positive rating and the DCF valuation suggests it's currently undervalued. Moving into Analysis 2.0, I plan to conduct a more thorough review of Amazon's business structure and validate my estimations of its true potential and fair market value. For those of you interested in my prior analyses, feel free to visit my channel, subscribe, and delight yourself.